Hello, chart watchers, and welcome to this Wednesday, February 21st, Market Watchers Live Show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, I'm having actually a little bit of difficulty switching my screen over, so I'm just going to tell you quickly what's going on in the market. We do have the Dow Jones Industrial Average up 113 points, the S&P 500 up 16, the NASDAQ once again leading, breaking above highs the past couple of days, up 64 points today to 7208. We've got the Russell 2000 up another 16 points today, reversing yesterday's losses. 10-year Treasury yield at 2.90%. And the volatility index back on the decline, down 11% today, back down to 18, close to 18 and a quarter. That'll be interesting to watch throughout the session. Industrials and financials leading the market to the upside today. Financials being led somewhat by the mortgage finance area, and the industrials being led by both railroads and airlines. Railroads reversing most of its losses from yesterday after a pretty rough day on Tuesday. A couple of other industry groups looking good today. Hotels within the consumer discretionary group up about 1.7%, and the internet space lifting technology stocks moving back, internet stocks moving back above their key moving averages. And with that, I'm going to bring in my co-host, Erin. How are you doing, and how was your trip to Vegas?
Oh, well, it was a great trip. I didn't come home with new money, but I did come home with some of my old money, so I consider it a win.
Oh, cool.
And the Ducks beat the Golden Knights, which was the whole reason I went, and we were shocked because they're just a crazy good team. So that was nice icing on the cake there.
Yeah, we were taking up collection for you since you were in Vegas for multiple days. When I go out to Vegas, I don't like to be there maybe for more than 2 days because you're really pushing your luck. If you can get ahead, you probably just want to leave because if you're there long enough, they're going to get your money.
Yeah, the blackjack was kind of hit and miss. You know, that's I don't know about you, Tom, what you like to play, but I always compare trading the stock market to kind of like trading, playing blackjack. I know I've written some articles about it, so I love it. I sit hours and hours at the table. It's just totally keeps my brain going. I don't tell, but I count the cards, so it I usually do okay. So
I prefer playing craps. Actually, there are some setups in craps where you get the best odds that you can get in the casino.
That's true.
Get 1-to-1 odds on some of them on occasion, some table, certain, depending on how they set it up. But anyway, we can talk about that some other time. We do have a special guest in with us today, Greg Schnell. How are you doing, my friend?
Hey, team. I am doing very good. Thanks for inviting me on the show today.
Yeah, I think you're doing better because you're not in Canada. You're down in...
I was in Toronto for the weekend. It was a little chilly, and I'm in Scottsdale today, so it's good.
Yeah, Scottsdale, Arizona is a little warmer this time of year than Toronto, I'm assuming.
True that, yeah.
True that. Well, we got a bunch to go over. Greg's gracious enough to be here with us today and going to give you his take on what's been going on in the market and talk a little bit about his book and so forth. But before we get into all that, Erin, why don't you go through the announcements and the agenda, and we'll get everything going.
Absolutely. So first of all, as far as our weekly schedule goes, we have everything stock charts coming up on February 22nd. I believe tomorrow we're going to be doing that. And then Friday, Tom, you're going to be doing a workshop, although at this point, I think it's going to be a little bit of a surprise. We'll know soon enough, and we'll let you know. And that pretty much covers what's going on this rest of this week. But today, as Tom said, we have Greg on. We're going to do a scooter report since one of Greg's specialties, I know, is the scooter. So we'll look at those. And then we have 10 and 10 to 1. Our first stock will be SORL, Sorel or SORL Auto Parts. I'm honestly not sure which one. And finally, I'll finish with the decision point report since I was not able to come in yesterday and do that. I'll give that to you today. And with that, I'm going to hand it back to you, Tom, but I think you might want to share that candle glance. It should be working now, according to our producer.
Okay, well, I already took down the candle glance, so we'll have to take a look at it in a little bit. But the 10-year Treasury yield, I wanted to focus on this because it is continuing to hover here at about the 2.90% area. We did have a few, two economic reports out this morning. February PMI composite flash, 55.9 versus 54.0. January existing home sales came out. That was about 10 o'clock this morning. 5,380,000 units came out. That was the actual number. Market was actually expecting a much higher number, though, 5,650,000 units. So we came up 270,000 units short, or roughly 5%. And, I thought, considering that news came out being so weak, I was, maybe a little surprised that the 10-year Treasury yield is hanging up where it is right now at this 2.90% area. But traders could be a little bit nervous. There could be some selling in the bond market ahead of the FOMC minutes that are going to be released at 2 p.m. this afternoon. That's going to be, for me anyway, pretty interesting to see whether or not the Fed talks much about inflation. Because that's really, in my opinion, that's what spooked the market here over the past few weeks. It's the surprise inflationary reports that have come out and what the Fed is going to have to do to address that if it is more of a problem than they had previously anticipated. So I think there's going to be a lot of traders waiting with bated breath for that FOMC minute report that will be coming out at 2 o'clock this afternoon. Now, as far as the interest rates go here, I wanted to pull up a long-term chart on on the TNX. Now, this is going back 50 years. I want you to look at the top that we reached at near 16% back in 1981. And we have been in this downtrend, this long-term downtrend, ever since 1981. We're talking, 36 years? So that's a long time to be in a downtrend. I mean, to me, a downtrend, it's 2 weeks, it's a long downtrend. But here we got one that goes back almost 4 decades. So clearly, this is a very meaningful chart that folks want to pay attention to, especially as it relates to the intermarket relationship between the bond market and the stock market. As we've been going higher, we did put in a double bottom, the 2012 low. We went back in 2016 and we essentially tested it, and now have started to move back up. I think a move above this reaction high at 3% is really going to start to change the character of this chart from a downtrend to potentially the start of an uptrend. And then the question will become, at what point do higher interest rates slow down the bull market that we've been seeing for 9 years? And I think that's a really tough debate, and you could pick sides and try to guess exactly at what point the stock market is not going to like the higher interest rates. I would say, first of all, we're coming off a double bottom in historic low territory. So the fact that we've risen off of historic lows, I don't think is that big a deal, as long as the economic activity continues to justify the rates moving higher. Now, if the rates are moving higher to fight inflation, then I do think we have a different animal, and I think that's why this 2 o'clock announcement today is going to be pretty big for traders. The trend line, I drew 2 different lines. If you just draw the closes and connect the closes coming across here, you come in with a trend line that's just a little bit above 3%. If I take the intra-month highs, this is a monthly chart, so if I actually connect the intra-month highs with the dotted line, you can see we come in probably closer to about 3.4%. So it really does depend when you're doing these trend lines. They're somewhat subjective depending on what exactly you're connecting. And then if I connected it exactly correct, you could argue that. So maybe instead of 3.40, it's really 3.43. The point is, trend lines give you an idea of an area to look at, but they are very subjective. I think a more telling level is this 3% level, number one. Do we go through? And so far, I would say we're certainly on a path to test that 3 level, and then we'll just have to wait to see whether or not we get through, and if we do we break that trend line. I wanted to go through a couple of charts with you. The first one is the XLY, XLP. This is my favorite ratio chart. Just tells you how the consumer discretionary group continues to perform relative to consumer staples, and I don't think there's any way really to misinterpret this chart. The XLY is just absolutely swamping the XLP. This is not normally what you would see at the start of a bear market. The XLY is made up of more aggressive consumer stocks. The XLP is more defensive consumer stocks. And as this ratio rises, it's telling you that traders are willing to put their money into the more aggressive areas of the market. Normally we see the opposite as we are topping. I want to take a look now at the S&P 500. This is where we stand right now. This is a 30-minute chart that goes back just beyond the top that we saw at the end of January. So here's where we topped out on the S&P 500. Here was the decline. Here's the subsequent rally where we're sitting right now. And we are coming off the highs. We are about 8 points off the high now on the S&P 500. It's going to be really interesting, like I said, at 2 o'clock to see which way this market goes. But the S&P 500, as it's been moving here, I want you to take a look at the key aggressive sectors relative to the S&P 500. Here is technology, XLK, and check out during this rally how the money has been pouring back into the technology group. This doesn't tell us that technology is going higher. This tells us that technology is going higher much faster than the S&P 500. It's outperforming the S&P. Normally, when you get these rises in a bear market, and I'll show you this in just a minute, money starts rotating out of these aggressive groups, not into them. The XLI just kind of going along for the ride. Really didn't get hurt too much during the downtrend, not really breaking out during the uptrend. It's just kind of going along with the S&P 500. The discretionary group here you can see started to turn back up again off of the recent lows, and certainly the financials with the 10-year Treasury yield climbing. We continue to see outperformance by the financials, and it's getting back up close to a high that was set earlier in February. Now, when you look at this, I'm going back to a period now on this next chart. This is, I had to do 1 hour candlesticks because when you go back in time, I don't think you can do a 30-minute candlestick if you go back beyond 60 days. So I used a 1 hour candlestick, and this is back at the end of November of 2007. So here was the top on October 10th on the S&P 500, and this is when we started to really fall apart. Now, at the very beginning, you can see technology continued to hold up pretty well. XLI actually broke out to a new relative high in this period after the selling started. If you look at the other two groups, though, the XLY was already way off of its earlier high on a relative basis, and the financial same way. But what I've really found telling here is when you look at these couple of rally attempts after the downtrend began, very similar to what we're looking at now. You know, we got a downtrend, now we're rallying against it. Here was a rally. Technology lost ground. Industrials lost ground on a relative basis. The consumer discretionary lost ground, and financials topped and began losing ground. And then you look at the fairly significant rally here in the latter part of November of 2007. Technology nowhere to be found, actually starting to roll over in a pretty big way off its earlier relative high. I mean, here is where we're sitting at 1481 here at the end of November 2007. This is where we were, 1481. So in early November, so over a 3-week period, the S&P went nowhere. But look what happened to the relative strength in technology during this period. Completely fell off the chart. Look at what happened to the industrials. Completely fell off the chart. The consumer discretionary just continually stayed weak, as did financials throughout this period. So my point here is one of the things that I look at is not just what the S&P 500 is doing in terms of points moving to the upside or downside, but where is the money rotating? And I think it's really difficult to get bearish the market when we're looking at the S&P 500 rallying and seeing leadership really from all of the key areas. Now, again, consumer discretionary, maybe a little sideways action, but we've got clear uptrend in the financials. Industrials trying to make a breakout, a relative breakout, even though the S&P 500 is still way below its prior high, and technology has broken out. So it's just it's a different picture that I'm seeing as we move into this, as we rally here on this move, and it's one of the reasons why I believe this is a correction, not a bear market. I'm not seeing the money rotate. Now, maybe it changes, and this is something that we're going to have to continue to watch as we go forward, but I do think this is really important to take a look at. Now, a couple of charts. I mentioned earlier that the railroads and truckers are doing really well today, and you can see the transports making a move up, trying to get through that declining 20-day moving average. It failed back on Friday. It got up close again today. Hasn't been able to get through. But if we take a look at the weekly chart on the transports, what we're going to see is that the pullback, really all we did is come back and test this breakout at 10,000 that we saw back in November of 2017. And after getting through that 10,000 level, we went up almost to 11.5, came all the way back down, tested price support, and now we're back up above the 20-week moving average. So I don't think the transports have done really anything technically damaging at this point. And the railroads and truckers, pretty much the same thing. A couple of key earnings reports that came out last night. Verisk Analytics, VRSK, posted better than expected revenues, better than expected bottom line, and they are trying to make a breakout. It's going to be interesting to see where VRSK finishes today. Dish, DISH, missed on their revenues, but beat barely on their earnings per share. Seems like traders concentrating on that the revenue miss, as we are still down dealing with multi-month lows on Dish Network. And Garmin, GRMN, this one came out this morning with earnings, beat on the top line, beat on the bottom line. Stock sold off, though, went all the way back down to price support and bounced off that 60 level, which I expect will continue to hold. So I think GRMN actually looks pretty good here on this move to the upside. One stock that got downgraded, it's in the biotechs, REGN, Regeneron Pharmaceuticals. Stock continues to drift lower and lower. This is one of the best performing stocks in the NASDAQ 100 over the last many years. As you can see, it's been struggling, but check out the price support that REGN is dealing with right now, down at about, let me shorten this chart for you. Let's just look over the last 5 years so we can get this number correct. But I think this is a company that looks pretty interesting down here around 325. That's where these lows were. So we're currently at a 2-3 year low on REGN. I'd watch for a reversal here. But this one looks kind of interesting. And with that, I am going to turn it over to my good friend, Greg Schnell. What you got for us today, Greg? I know you just published that book. Congratulations on that. How's that going?
You know, there's a lot happening out there. For everybody who doesn't know, I'm not usually I'll call it a published author. So the book was a big challenge for me, but it's out now, and it's actually been moving dramatically faster than we had than I guessed it would. So anyway, so that is good news. I think there's a couple of things I'd like to go over today. I've kind of got 10 charts that I think are pretty interesting. Just to be aware of the market psychology and what's going on. I also wanted to touch on a couple of things from the book, just, you know, not just showing, I'll call it beginner investors how to look at charts, but also some technical details about charting that are pretty important for people to be aware of. So maybe just as an example, I'll start with the Russell. And one of the things you notice on the Russell here is in January, the high was 16,1071 if we look at this line chart. And if we go look at the Russell on a weekly, this one says 160806. And if we go look at the Russell on a monthly, this one says 1574.98. And one of the questions that we have about the charting is somebody will go, how could it be different on each one? And what the important thing is that the chart in this case is using the close. And if I convert this chart from a line chart to candlestick chart or a bar chart, what you'll see is that this will come up with a number of an intraday high of 1615.52. And so when you're looking at your charts, depending on how you're displaying your charts, it could show different data, and it's really just the charting style that you're using that's creating it. So now on a weekly, this is 1652, and if I go to the daily and change it to a bar chart or a candlestick chart, it's going to show me 1652. So the idea being, there's a lot of things that go on in charting when the charting engine is working, and if you understand all the nuances of how the settings are set up on the chart, you'll get the data you're expecting. But if you set up the chart differently than you're expecting, you know, some things you'll sit there and go, how could we have 3 different highs for the market in January? And the point would be that Intraday highs will be the same, but if you're using a line chart, it's based on close only, or a mountain chart, or an area chart. And when you look at that data, one of the important things to be aware of is just, have I set it up the way I've set it up? Or have I set up the data the way I want it for the information I'm trying to gather? And so hopefully in the book, that's the kind of thing that I've covered off. And I think some of the stuff in there, for advanced chartists, it'll be more of a tips and tricks book for you. But for newer investors, it'll probably help you get your raw charts up and running. And I've received lots of comments on some of the ideas that people have found in the book, that they just were unaware that stock charts could do that. So hopefully you find the same thing. Anyway, there's some nice comments coming out on the chat room. So thanks everybody for the kind feedback. Okay, and getting on to what I wanted to talk about today, I'll just talk about a couple of things that I've set up. Every year when I do my blogs and articles and stuff, I save my charts to a common chart list. So just this was the second half of last year. This is the beginning of this year. And if I go down a few pages here, I've got some other chart lists from years ago, so 2012, 13, 14, 15. And just go back and look at what you're thinking at any given point in time. And you can see that, each year as you're writing more and more, and it doesn't matter whether you're writing an article or not, but it's a good idea to just save all your charts continuously. And so one of the things I like to do, when somebody tells me I have to go watch The Bachelorette or something, is just scroll through these charts and put them in a simple chart list so I can just see what I've got. And sometimes my comments on the charts will be prescient, or sometimes I totally missed it. And so then it gives me an idea of what I should be looking for that I perhaps missed on that chart. So as an example, in this particular chart, you just draw a trend line here. And, when you draw that trend line, so the date on this chart was February the 12th, it was just breaking this trend line. And you can see that, for the India stock market right now, this is a pretty critical point on the chart, obviously, threatening an upward trend line. RSI's at 50. We're on a weekly chart, so normally a good chart will hold at 40. But we can see that the PPO momentum trend line is breaking, going all the way back to the lows of 2016. To me, that's a really important trend line. And so I like to watch things like that. So just by setting up all of these charts, anytime I'm annotating it, if I'm not, if I've actually bought the stock or whatever, I'm not going to keep it in this chart list, but I'm going to keep all of the charts that I'm just annotating and making notes about. And when you go look in this chart, I think one of the things you'll find, let's just go back to the summary view. Just looking through the year, what's important to me, and I've got copper and CRB in Germany and the railroads and natural gas and silver and gold, whatever. As you see these charts come forward, they're the ones that I'm paying attention to all the time. And so I commonly get asked, what do you like to look at? And if I mailed somebody this chart list, this is exactly what I'm looking at. Because if I post it on Twitter, I'll throw it in this chart list and I'll send it out. Or if I post it on one of the blogs that we write into, this would be the place for it. So just one of the ideas around setting up your charts, if you're trying to journal your work, this is a nice way to just kind of keep a list of all of the charts you're looking at. And of course, I try to add the date. So in this case, 2018-01-25. And let's just talk about the US dollar right now, because I think it's pretty important. It's one of the charts that I think right now is critical, and almost everything in the market feels like it's set up to pivot on the US dollar to me right here. So first of all, this is just a daily chart, and we see that the MACD trend line would be broken here, and we're starting to make a higher low even though price made a lower low. So that to me is concerning. Now again, it's using the closing price, not the intraday low, but it's still making a higher it's reversing and starting to work its way higher. And this turn up in the daily is important, but more important is the setup on the weekly. And what we see here is, and by the way, Mr. Bowley, nice charts. I noticed you changed it from your sunset setting, so that was kind of fun to see.
I'm still seeing my therapist over it.
I'm sure that was almost like taking off your left finger or something.
It's brutal. It's brutal. Let's not talk about it, please.
Okay. So anyway, we've got the US dollar and big trend line here. I mean, this looks like a topping structure for sure. But what's happened is after we broke down, normally in here, you would expect this to just start running like a river or a waterfall, just falling completely apart. And we're not really seeing that. We spent almost 5 weeks here just kind of consolidating at these lows. And so I'm starting to get a little suspicious of the move. And much like we saw on the daily chart, was that we're starting to make a higher low on the weekly chart, and you can see this is comparing to the September low versus now, whereas on the daily chart it was literally just comparing these two lows from January and February. We got all the way down to a 30 oversold level, and we're trying to bounce out of here. So this is an important place on the chart for all of us to be aware of. Now, if I get into more US dollar charting here, this is just obviously zooming that whole thing in, but you can see we have a big downtrend in momentum. In this case, it's using the MACD over a 3-year period. The price hasn't moved too much, so the MACD is okay. When you have huge price moves, let's say NVIDIA or something like that, then you probably want to use more of a PPO to express that. But usually, even over long time frames, the PPO can be a better indicator. But this is working just fine for the way we've set it up. But we see this higher low starting to develop here in the MACD, big lower low in price. And it's that particular combination that at least makes me want to check my work a lot. If the US dollar isn't going to continue breaking down, that would shock pretty much everybody, because even CNBC is calling it a bear market for the dollar now. And they usually call it, we've been in a downtrend for 18 months, and now they're calling it a bear market for the dollar. Well, it's been going on. I think we made note of it back in July of last year. And I'll show you the signal we got to make that call. Now, here's the US dollar sliding. This is a huge downtrend. We're going on 15 or 16 months, and you can see lower lows here. This is, breaking down. So we saw the major low come into the market here. Then we broke all of the downtrend, came back up, rallied, and rolled over. Well, you can see these are my notes from the chart. This goes back a year ago, and I just keep replenishing the chart. I take off a whole bunch of trend lines because otherwise it would be a mess, but you just keep cleaning it up. And here you see a lower low, and price was not making a lower low yet, and all of a sudden it lets go. Now we're starting to make this higher low here, and you can see it didn't even touch. And sometimes that's probably a better signal, is when it actually doesn't come all the way down to your signal line and it takes right off. That can be a pretty good clue. So I'm just going to work through some more of these US dollar charts. This one is a much bigger picture. And you can see right here, the RSI hit 30 in July 20th of 2017. And a Friday close suggests a new bear market. So on a weekly chart, you need to wait for the Friday close. Well, what happened was, sure enough, the market literally fell from about here all the way down and broke out through the bottom. And so for the better part of 8 or 9 months now, I've been on a bear market signal for the US dollar. And now the question is, if that's not continuing, if we were going to change that, what would it be to change? And so I wrote in here that, if I listen to my bias, I would expect more of the choppy action on the left. So basically the MACD just working its way sideways and oscillating in here. Or does it start to change direction? And you can see when these major trends in momentum break, it's a pretty important place to be aware of. And so this particular point here in 2014, it was also a trend line break on price. But when you're getting this major momentum surge and starting to go past previous momentum lows, that's a critical point. In this particular case, we can go and we can draw a big line all the way across all of this and say that we should be in a new bear market and we're breaking down. And now we've got a lot of negative momentum. So it's not obvious that the bear market won't continue, but it looks definitely to me like it should. So that's one of the reasons I'm so suspicious of it, is just this weekly has rolled over right here. But if it started to make a higher low, I'd want to be aware of it. Now, here's the problem on this chart. January 25th is the date setting. So I'm going to change that to today and just add that in. And all of a sudden, what do we see? We see that, yeah, watch how this momentum shapes up. And now it's starting to look like it wants to turn up at a higher level. And so just making notes on the chart, I think, is pretty important. But the US dollar is one of the ones that I think is really setting the tone for everything. As we know, commodities have been ugly in January, in February, which wasn't what we would have expected a month ago if the US dollar was just going to be crashing hard. So with that, let me point out a few other things, and then I'll flip it open for questions or turn it back. First of all, we have a couple of other stock exchanges in Canada, one called NEO and one called the Canadian Stock Exchange, which is different. The main one in Canada is called the Toronto Stock Exchange. And Stock Charts has just started to carry those charts. So here's an example, Glance Technologies, and it's been trading for quite a while, but anyway, Stock Charts now carries those. And what we're going to move to is that every Canadian ticker symbol will have a .ca at the end of it, but it'll take us a couple of months to get that all rolled out. So if you're a Canadian investor looking for some of the marijuana stocks or some of the other stocks that weren't accepted on the main exchanges right away, and we're trading on the other exchanges, those are now coming to Stock Charts, just to make everybody aware. Okay, let's get into gold, because there was already some chatter about that this morning, and I have some really interesting views on gold. And the reason they're so interesting is I think there's a guy named James Flanagan who runs a website called GAN Financial, and GAN did a lot of historical analysis to try and say, based on the move, the big moves in gold in history were from this point, and it ran for 2.5 years and it made 180% or whatever. Like, he would go back and do an analysis of history as to find the biggest moves in gold or in the commodity he was looking at. And what I noticed about James Flanagan's work currently is he's expecting kind of a major low that breaks all the previous lows, gets everybody to throw in the towel, leave the trade, and then reverse. And in gold, he's been writing about this for a couple of months now, that he's expecting that. And so the price action in gold, so this is GDX that I'm about to show you, and that was an intraday chart. This is daily. Now, it's really hard to make money when this chart is basically just whipping between $20 and $25. And some of the moves are $1 a day or whatever. When you're getting this sort of choppy action, that's not what we call a trending market. It's a trading market, if anything. And here's the weekly view, and you can see that going back for a whole year now, we have basically chopped between $21 and $25. I get it, that's a 20% move between the 2 points, but you have to pick the bottom and pick the top almost exactly every time. So right now we have a flat 40-week moving average, which would be equal to a 200-day. We have a flat 10-week moving average, which would be equal to a 50-day. We have a straight sideways motion. The Bollinger Bands have just, been stuck in this range for a long period of time. The S&P has been a big outperformer, but you can see gold has been unable to outperform. And recently here we got a brief stab below on GDX, and I wondered if that would be enough to kind of make all of the bears capitulate, all of the bulls capitulate. But it basically spent a couple of hours down there and turned and reversed higher. So what we probably want to see is some major flush that comes all the way down and really kind of gets everybody bearish. And again, we still need the dollar to cooperate. So I'm watching gold specifically for that sort of thing, and again, when you're getting down here, you're looking for at least just a channel trade where you're basically buying it near the lows and selling it near the highs if you want to trade chop. And if the overall market's going to chop, it's better to get that sort of, you want to buy near the lows, especially in commodities, and watch for a breakout later. But at this point, you know, a lot of people are just selling up near the highs, as we can see over and over and over. And if we look at the P&F chart, you know, this is pretty good example of just how choppy it's been. Basically, it just takes out the previous low, turns and reverses right away. So it's really working everybody. Same thing on the highs, makes a new high, turns and reverses right away. It has been difficult to trade the gold market, you know, going back for the last year. And, you know, as Tom will say, well, it's not outperforming, so why would you bother? And I think that's a very good point. The big thing that we were starting to see was if the US dollar was going to be in this big bear market, then we would expect gold to surge. And one of the things that hasn't happened is that gold has not surged with the big break. So there's a couple of charts that I like to look at specifically, and GDX is obviously one of the easier ways to invest in gold, but the other is watching this ratio of GDX to GLD. And what we see here is this ratio is starting to break down below the 2017 levels, down into the 2016 level. But this ratio, when we had a big bear market, was falling apart. Now, again, what happened here on the lows was as commodities came down and got really, really ugly, everything was testing the lows, and we turned around and bounced and reversed. And this was 150% run, not in the ratio, but in GDX, which is the average of the gold stock. So one of the things we're looking for is that sort of a setup where you got positive divergence on a weekly chart on GDX. Let's just go back there. And so we were making higher lows in momentum, and the price lows were the same or a little bit lower. Right now, we've just flatlined. I mean, there is no emotion here one way or the other. The momentum is zero. And one of the things that James Flanagan talked about was on one of them, on a couple of the major lows in gold, what happened was all of a sudden there was a clean flush and everything kind of broke. And it was at that moment, after the US dollar was kind of setting up properly, that you would get this big reversal to the upside. And so as ugly as gold is, and as boring as gold is, and as little trading opportunity as there's been in gold, one of the reasons we're watching for it is if inflation is supposed to rear its ugly head, we would expect this chart to start to develop some potential energy and get going. And again, as a commodity trader, you're trying to buy near the lows and sell near the highs, not trying to buy breakouts as much. Some people still do, but one of the things about gold or commodities in general is, as an example, you know, if the price of gasoline goes up too much, what does everybody do? They stop buying gasoline. You know, if Netflix increases their sales $1 or $2, that would be a breakout to new highs. But again, they're only going up $1. And so everything kind of has a price ceiling around it for a period of time. And commodities in general have a minimum and a maximum. So they can tend to trade in a range, and you want to try and buy near the lows. So a full stochastic indicator or a commodity indicator would be a great help there. Now, let me just cover off a couple of the other charts because they're ones I'm still watching for. Here's the PPO for silver over the last 5 years, and you can see the momentum on this is flatlining as well. But we still have this big uptrend in place, and we're right at the zero level. So we're still trying to figure out if this has any momentum to break out. There's a very clear downtrend in the highs here. Not as clear uptrend if I come off this low, but if I come here, you know, pretty much a horizontal level at 1550. So silver's on my radar, and we keep watching it. For those interested, I think the energy stocks are a bust. They just haven't been able to break out. I keep looking for natural gas here, and one of the reasons is it's right at 260. So a couple of other charts that I think are critical right now to be aware of. One is this Euro chart, and this is the big 10-year trend line on the euro, and you can see we're testing it right now. And here's an example of Greg continuing to add trend lines and not cleaning up the chart. But when this broke right here, look at how significant that was, and all of a sudden it was a waterfall event. So, you know, these long-term trend lines on weekly charts are really important. Conversely, on the other side, this breakout right here was a really nice one. It coincided with a big 6-year trend line breakout, and off we went. Now what we have here is this looks like it wants to roll over right as we get up against this momentum level or this trend line. And if that's not going to hold, or if it's going to stop the move in the euro, I think we all want to be aware of that. There's another chart that I have, I think it's this one. Yeah. Let me stretch this out a little bit and just change my chart size. What you see on this chart was that every time that the euro topped, this was 2008, late 2009, the market, it kind of rallied up to this level, but the market just kind of went sideways for a period. In 2011, you might remember that kind of marked the Asian or the European financial crisis, where we were talking about the pigs, Portugal, Italy, Greece, and Spain. And that created a market correction of almost 20% in the S&P 500. And then when we got up here into 2014, this actually happened in January. Oil topped in June, and the market ran for another full year. But underneath the surface in here was all of a sudden a lot of sectors starting to break down. And this big pullback in oil kind of caused a bump in September, but that was about it. And again, the Fed was on the gas pedal through this. So if you're trying to draw a trend line where the Fed was involved, this was like 2 trillion. So you could just say hello on that one. It's pretty hard to change the trend of anything. Right now, here we are, and we're up against this trend line now. So not saying it's going to break down. I'm just saying it's pretty important to realize that, you know, when the euro rolled over previously, it was at least worth making a note of. And so that's what I'm doing on that chart. Looking at the Japanese yen to the US dollar, this has broken out. And one of the things that I would expect is that if it was going to break out, gold would break out. So this is the Japanese US dollar on a weekly chart. Here's gold. And so, you know, they follow each other pretty closely. Maybe they're on different scales, so where they cross is irrelevant. One's a $13 and one's an 80 cent level here. So you can't use the scales, but we're looking for the general trend, and you can see that they follow each other pretty good. So the yen has broken out over the recent summer highs of last year. Gold has been unable to do that. And so still watching to see if this is all going to coalesce. And as Erin likes to say, technical analysis is a windsock, not a crystal ball. And what we see there is, you know, we've broken this downtrend on the PPO. There's lots of reasons to expect the yen to break to the upside, and I've been watching it very closely. The real question is, we're still not seeing the breakout in gold. And the other thing that isn't happening is when the US dollar broke down back in 2002, gold spiked before the US dollar broke down. And as gold started to spike, the dollar started to break away. Now we have exactly the opposite. The US dollar has broken down, but gold has not been able to break out. So it's throwing a big question mark into my analysis as to what's going on out there. So I'm getting a little more concerned. I've got probably 3 more charts here that I wouldn't mind clearing off with everybody just to make sure that they're aware of, and keep an eye out for, and then after that I'll flip it back. But one of the things that we see here is a big uptrend that we had going on in the US railroading, and it was one of the first clues that the market was starting to break down. It had broken below its 200-day. The 50 was coming over to cross in April, and you might remember that the US market topped May 15th. But the railroad had started to break down back in April. It had broken below its 200-day moving average, and it started to roll out. Here we are on the uptrend now, and what we see here is the Railroad is still looking okay. It's well above its 200-day moving average, came right down and tested it. But I will say that when these long-term PPO lines start to break, you just want to be aware that they are breaking. It doesn't mean that you immediately go to a sell signal, but by then it was telling you that this was a sideways movement and not continuing to trend. Here we have a big 2-year uptrend, and we're right at that trend line now. Same thing on price. We're right at the 2-year uptrend. So if this was starting to weaken anymore, I want to be very, very aware that something's changing in the railroads. And if that's going to continue to work, great. If it's starting to weaken, I want to be a little more focused on what else is going on. Okay, last chart is the DAX. And what I want to show here, Tom and I have agreed over time that the DAX does a good job of representing the U.S. market in some situations. Now, what we see here is in 2017, we had a high around 12.9 and 12.950. And let's just shrink it back a little bit. But what you see here, let's just call it 13,000. So we broke out, ran up for 2 weeks, failed to break out. Now we spend almost 3 months going sideways. We try again, we get up here, briefly make a new high, and immediately give it all back. But don't just fall down a little bit like we did before. We blow right through support. We come all the way down, and now we're at the previous summer's support. So we're back near 6-month lows. And you can see that this would be typically a head and shoulders topping structure setting up. We're starting to break the trend line here in price. I'd say we've broken it. We've tested it, and we spent 3 weeks underneath it now. But one of the things that I'm really watching is this MACD, or is it MACD? I've set it up as the PPO here, is at the 0 level. And so if it does not hold up and starts to go below 0, here we are back in 2015, and it was breaking down. And in 2014, it had given us a signal that the market was a little weaker. So the U.S. market is one of the strongest markets in the world. It's probably usually the strongest market in the world. So I don't expect it to be the first to break down. So when there's problems elsewhere in the world, then I want to use that information to help me be more attuned to difficulties in the U.S. market. So I have a downsloping PPO top here. I have, an upsloping or at least flat top, if nothing else. But to me, this looks like a double top structure. And we made lower highs on this one. If I compare it back to last summer, we had higher highs in price and lower highs in momentum. We're going across the 0 line. So I don't like that. If I just change it to be the Canadian market, which is one of the U.S. market's largest trading partners, we took out last summer's lows. We were at new 52-week lows here just a couple of weeks ago, and we can go all the way back to 2008. So the Canadian market is a heavily commodity related market, and what we see here is it's been unable to hold these big major breakout levels, and so that gives me more consternation towards gold, oil, silver, nat gas, copper. All of those charts make me really suspect that things are not quite as they should be. When all of these markets like Australia, Canada, Russia, Brazil were all moving to new highs in January, I was quite comfortable that this bull market we were seeing is starting to break out. Now we're getting exactly the opposite. Lower highs on the PPO, almost at the 0 level. Now it's trying to bounce from here, so it's an important level. But, we're breaking these upsloping trend lines like I showed you on India. So that's a concern. The Shanghai market is below its 200-day or 40-week moving average, so that's a concern. All of these things are starting to add up, and they give me reason to be cautious on the U.S. market. So for the U.S., I would expect more. I would expect to run towards the highs at least and get back up there and test it, and either make a lower high or a higher high, and then see how we resolve. But I would say March, April is going to be a pretty important time frame for retesting these prior highs, and how the market responds is probably a better clue.
All right.
So, yeah, with that, I'll turn it back. Thanks.
I think we forgot to tell you there was going to be a second segment, but that's okay.
No, that's fine. I mean, you went through a lot, and I think you gave everybody a lot to think about, and different trend lines and different markets, different asset classes, different things to think about, no doubt. And with all the turmoil that we've seen in the market recently, certainly some food for thought for everybody. Um, I have one chart that I can go through fairly quickly, Erin, on
Yeah.
the scooters. If
Yeah,
you,
go for it. I'm getting the 10 and 10 ready for you, so that's good.
all right, I've gone through this chart before, but I want to kind of just go through my thought process sometimes with how I would use scooter reports, going from maybe an idea or a trading strategy and then trying to find a stock that fits that strategy. I talked yesterday, and I've talked in recent days about the fact that the 10-year Treasury yield here in the U.S. continues to rise versus Germany, and how prior times where we've seen this movement to the upside with the dollar falling, normally they tend to go hand in hand. But when the dollar falls, then usually the dollar plays catch up. It has the last two times. And in both of those instances, we saw huge outperformance by the Russell 2000, because as the dollar rises, that has a negative impact in the earnings of larger companies found on the S&P 500, the multinationals. So we're in this situation right now. And I agree with Greg on one point in particular, and that is I think the dollar and what happens to dollar here is going to have a really big impact on a lot of different areas of the market, different currencies, lots of different, looking at the treasury yields. I mean, it's going to have a really big impact. And if we do see a rally in the dollar, and I think that we're at a key support area, we had a triple top breakout at about 88, 89 on the dollar index, and we've pulled back right to that level. If I connect to the trend line of the lows, we'd be right at about 89. So I think this is a pivotal area for the dollar. If we didn't pay attention to anything else, but the fact that the U.S. yields are rising faster makes me think that the dollar is going to play catch up again and rally, even if it's just short term. And if that happens, what I would expect is the Russell 2000 to bounce off of the relative support relative to the benchmark S&P 500. So having said all that, if I'm right about the dollar bouncing, I want to maybe look toward the Russell 2000, the small caps. So let's go over now and let's look at the scooter reports from the dashboard, and you can change the scooter reports to small caps. All right, and when you look at the small caps and start moving down, many of you, I think, have heard me talk about media agencies. And in fact, I think this is a group that's been underperforming for quite some time. It's in the consumer discretionary area, which is the best performing sector. And the media agencies group is actually just starting to make pretty good movement to the upside. I can show you a quick chart here. This is the media agencies. It's been underperforming for about a year and a half in this downtrend, but check out, it's starting to break this downtrend line, and you can see that the weekly PPO is looking much better as well. And if I shorten it down to just a 3-year chart, you'll see that recently we're starting to hang on above this rising 20-week moving average, where before we were constantly trading beneath it. So I think that the media agencies group is an area to consider. And here is a media, I just had it up here. Here it is, the media agencies group stock, QNST. Now, I actually bought this stock earlier this morning. It's the only stock I own right now, and I bought it on this breakout because when you look at the DJUS AV chart, you actually see it's been pulling back here over the past 4 or 5 days. But then if I go to the QNST chart, you see it's actually breaking out. So you got a stock that's outperforming a group that is outperforming or starting to outperform other areas within consumer discretionary. As long as the Dow Jones US Media Agencies Group continues to trend higher, I would be interested in looking at stocks within that group. The fact that QNST also falls into that small cap space that could benefit from that ratio that I just talked about. If the dollar starts to rise, that's why I thought this chart on a breakout was kind of interesting. And you can see today the volume's pretty heavy as well. So I just wanted to point that out, how you can take a strategy or maybe an idea of what you're looking at in the market, what you think might happen, and then combine it with an exclusive tool here at Stock Charts, the scooter rank system, to be able to find some really interesting stocks. QNST is one of the highest ranked scooters among small caps.
Excellent. That is one of the better ways to do. I know with the analysis that you do, Tom, a lot of it is based on finding those strong sectors and drilling down to the industry. And that's such a useful way to use those scooter reports.
Yeah, I think so. I mean, it's all sorted for you. I mean, everyone has a different trading strategy, and you certainly can incorporate, the scooter reports into whatever trading strategy you use. But you saw how quickly, I've talked about the fact that I think the dollar could bounce. If the dollar bounces, history tells us that the S&P 500 typically will underperform small caps. And so if we think money's going to rotate towards small caps, and then you find an industry group you like, you go into the scooter report, and sometimes it can be pretty interesting, some of the things that you can find. And going back and looking, got rid of something there, sorry. I was going to go back. There were a lot of biotechs on that list, by the way, and biotech's another area that I like, so that was the only other thing I was going to point out.
All right.
I would say the other thing, Tom, is on your weekly chart of the industry group there was a 15-month downtrend line on that PPO, and that's been broken. And I'm with you. That chart looks beautiful for a setup. So, in terms of the stuff I look at, I like that PPO to be breaking out above a downtrend, and that turned out great.
Yeah, and I'm just gonna share the screen real quick so you can see what he was talking about. But here is the PPO that he was referring to and how it's been downtrending for the last 2 years. Yeah. And now this move to the upside actually has broken that downtrend line. So go ahead and take it.
I love that. Yeah.
Yes. All right, let's get back here. I'm going to show you the group of the 10 and 10 that have been requested for the day. And it's actually very easy. Everybody's so impressed that I have these ready for you. But it's very easy to just add. If you go down here in the edit mode, you can just add as many charts as you want, separated as it says by a comma. And so I get these in actually pretty quick. So I wanted to look at the RRG very quickly, and then I'll start handing you some symbols.
Yeah, what was that first one? Do you know?
SORL. All right. So here we have the RRG of this particular group, and I'm going to have it fit it all into one. Let's see. I want to update it to the daily because we're looking at this short term. And as you can see, it's all pretty much stuck right there around the middle. So if you push fit, that'll put all of them in there. But if it's looking a little bit crazy here in the middle, you can always zoom in. But if you recall, when we had Julius on the show last Wednesday, a lot of the ones he likes to look at are the ones that are away from the center, because that can mean that they're either performing relatively better to the S&P. And so that's what you want to start looking for. So he likes to look at some of these outliers, as well as those that are moving in the right direction, which would be your northeast direction. So there you go. And let's go ahead and trade it over there, Tom, and start with SORL.
Okay, I'm going to start with that relative chart that I like to do from time to time. This is one, and I'll scroll down here real quick so you can take a look at the settings, and you can always come back to the recording and duplicate those settings if you'd like. But essentially what I've done here with SORL Auto Parts is I have the price chart here at the top going back, I don't know, 10 months. And then I've got a chart of its industry group, which is the auto parts. And you can see that it's continuing to trend higher. And then the next is SORL relative to its peers in the auto parts. And you can see it peaked actually several months ago, was downtrending, started to move higher, and then downtrending again. Now it's starting to turn back up again, which I guess short term anyway is a little bit of a positive. Then I've got SORL against the S&P. I think it's a smaller company though, so maybe a different index would probably, maybe the Russell 2000 might be a better indication. Or something better to compare it to. And then finally down here at the bottom, I've got the industry group relative to the S&P 500. I think it actually, after a big move up, after the industry group had a really good August and September relative to the S&P 500, I think we're just kind of sideways consolidating. So I'm okay with the group. Looking at the particular stock here, we did make a breakout above about 580 or so, got up as high as 850. Made our way all the way back down. I like that reversing candle that took place right near this price support area, and that has been holding. I think as long as you hold, say, 575 on a close, I'd be okay with SORL, and I would be looking maybe had a lot of support at about the 660, 665 area. So that is where I think we might be heading here in the near term. Also, You can see that declining 50-day. So a lot of overhead resistance, but I would say in the near term, the trading range on this one would be, say, from 575 up to about that 665 area.
All right. Let's see. The next one I have for you is Grubhub, of course.
All right, let's take a look. I'm going to stick with what we've been looking at here. You can see that this is part of the restaurants and bars, DJUSRU, which had been struggling for a while, and that, of course, Grub went down as a result. But this is clearly an outperforming stock. You can see relative to the restaurants doing very well. Here's relative to the S&P 500, and this is in a group that actually is underperforming the S&P 500. So the restaurants have not been very strong of late, and yet Grub not only is outperforming its peer group by a mile, but it's also outperforming the S&P 500. As far as somewhere to maybe look for support, I think you've got gap support. This was an earnings-related gap up on massive volume. I think as long as $85 holds, we're in pretty good shape here.
All right. Next one I have is HOV. I can't pronounce it right now. Hovnanian Enterprises, I think.
Yeah, it's a home builder.
Yeah, that VN is confusing me there.
Yeah. HOV continues to do well, and actually with a not so great existing home sales report this morning, stock's doing pretty well. I do like the fact that it climbed back above the 20-day. Anytime you're in a stock that loses the 20-day, it's always a good thing technically to get back up above it. So my guess is that we're going to trade now between the two moving averages. So I would be looking for support now coming in. You've got gap support and the 20-day moving average, both at about 2.25. You've got the 50-day moving average and the recent high from just yesterday between about 250 and 255. So that's, again, a trading range that I would consider. And this is important because I think a lot of these stocks now, while we've seen some breakouts, for the most part, you got a lot of stocks now consolidating. So I think trading ranges are going to be more the norm.
Okay, let's see. The next one, Nectar Therapeutics, NKTR.
Yeah, I think this one actually was on that small cap scooter listing I showed that has like a 99 scooter rank. So this has been a great performing stock for a long time. I think what we've got is a little cup and handle. So off of the uptrend. Let's see here. So obviously I think it's pretty clear you got a nice uptrend here. But if I go from the closing price, and I like to use the parabola and just kind of right from there down to maybe the low and then back up here to the high. Maybe not a perfect cup, but certainly a rounded bottom coming back up. And then you can see we're just kind of hovering here in what looks to me to be a handle just above the 20-day moving average. I would look for a volume break above 90. I think that would be a bullish development for NKTR.
Okay. One we haven't looked at, I don't think, in a while. Of course, I don't know what exactly you looked at yesterday, but how about First Solar, FSLR?
Yeah, it's renewable energy, but I think it's actually categorized as a semiconductor stock. It's, I think, battling some overhead resistance after breaking down on some heavier volume. So I think the support I was looking at was like right in here. You can see all of these lows coming down just below the 68 area. And once we went below, really struggled to get back up above and then continued to sell. You can see a lot of the volume bars are red, meaning that they're accompanying down days. So it looks like some distribution, but the overall uptrend, I think, still does remain in play, the longer-term uptrend. So I think that was a significant reversal in Doji that printed a couple weeks ago. But we've got to get through, I'm going to say $68 to really, I think, start to get this thing to go back to the upside, and heavier volume than normal would be a bullish signal as well.
All right. In the healthcare biotechs, Celgene Corp, CELG.
Yeah, Celgene is one of the bios that have really struggled. And again, you're looking at a stock that just recently broke down below the prior lows. Let's annotate that support level. But there's your support. Big breakdown. You can see the volume expanded a little bit on that move to the downside. Notice when we came back up, we failed at price resistance and the 20-day. And so at this point, we're just drifting. Now, one positive I think that is setting up here on Celgene is if we make another move back down to 90 or in that area, check out the PPO, which has now been rising. So we could get a positive divergence on another move to the downside, especially if that move to the downside is on just kind of light volume, light to moderate volume, and you see the stock back into the low 90s. It could be a pretty good reward to risk play. So I like Celgene because it's in the biotechs, but it clearly has been one of the underperformers.
All right. Next one I have for you is from the defense industry, would be AAXN, Axon Enterprise.
All right, AAXN. Well, I love the defense stocks. I think this is, when I've done seasonal views of different industry groups, and I think defense is the only, or one of the only ones that is up almost every. I think it might be every month on a seasonal basis. So this is a group that just tends to do really well over long periods of time. And so we did get a breakout here. I think your price support is going to be the most important thing to watch, along with the rising 20-day moving average. Price support, let's call it 27.75, and the rising 20-day moving average at 27.05. That would be an accumulation zone on any further weakness. I think the stock looks really good.
Okay, let's see. UPS will be the next one.
Yeah, UPS and FedEx hit recently because of Amazon coming out and saying they were going to get into their space. And that's never a good thing, as we saw with many of the broadline retailers and actually some of the food distribution companies when Amazon announced they were buying Whole Foods a few months ago, or however long ago that was. So I think some of it's an overreaction. I suspect that we're probably going to start to regain some strength, but it might take a little time to make the chart look a little bit better. I suspect that today's candle, which looks pretty bullish, we might get a move back up to 110, 111 to test this breakdown area. That also would get us close to this declining 20-day moving average. So I think we got a few dollars, another maybe $3, $4 to the upside here with UPS. But I don't suspect we have seen the bottom. I think we might have one more push to the downside, maybe get a positive divergence to develop, and then maybe we can start to look for that bottom on UPS.
All right. Next one, California Resources Corp, CRC.
I think this may have also been in that small cap. I saw this stock recently earlier today, so I'm thinking I may have seen it there as well. We went down just a little bit below price support, and this might have been one of those Wyckofian springs. But you can see right here we made a breakout. Look at the volume coming in to support this breakout. Kept rising. We went down and we went just a little bit below the support, put in a hammer, and then we started to move back to the upside. I think the key level, this support area right in here around 1780 up to 18 and a quarter or so, is pretty important. And so as long as we hold that, I'm okay with the stock. If we break below it, I'd be careful, especially if the volume picks up again. To the upside, I think it's pretty clear. You got to get through both these moving averages now, which are almost on top of each other. 20 days at 1983, 50-day 1988. So if you see a move back up over 20 and the volume starts picking up, I have a feeling what this will end up turning into is maybe some sort of a cup.
Okay, and the last one is going to be ExxonMobil, XOM.
All right. Sorry. I don't know why that didn't save. All right, ExxonMobil. Still not saving.
Weird. Well, producer says that's number 11 actually instead of 10, but I thought I had only 10, but.
All right, well, it didn't want me to let's save that. I don't know why. I'll have to go back and look at it.
All right.
No, it told me there's a little problem. All right, I think what's happening in stock charts is telling me that we must have done 10. Let's just move on.
Yeah, exactly. All right. Well, with that, I'm going to do our, actually, let's look at our 10 and 10 symbols, SORL, and there you go. The rest of them, I will have these up in the Market Watchers live chart list shortly after the show. So you'll find them there with all the annotations.
I actually think you were right, Erin, because I see XN. That was not one of our symbols.
Ah, there you go.
We had 9, but that's all right. We'll make up for it tomorrow. But we need to get going and take a look at the market update and see what's happening. And I know we got stock charts, ChartCon coming up in August. So maybe take a couple seconds, talk about that as well.
I absolutely will. I know we've been talking about it a lot, but for good reason, because it's going to be only the best charting conference out there. And you don't have to actually travel to go and watch it. We are going to be streaming it live. You'll see us standing up there. You'll actually see our faces and everything else as we present Reducing Risk in Uncharted Waters. So if you are interested in registering for that, we'd love to have you join us. But also, and again, you can find our agenda and all of the different speakers and what we'll be talking about. It's going to be invaluable. And once you have that, you do get to keep that recording of the live show, etc. But there's also the opportunity to come in person. And if you are interested in joining us at ChartCon and having a front row seat to all of those presentations and meeting all of us, that would be great. We'd love to have you. And there's more information on the website at stockcharts.com/ChartCon. So hopefully you'll join us. If anything, you need to join us as far as being online. And we do have some apps and such that'll make it easy for you to communicate with us, even though we are at ChartCon. So there you are. And with that, I'm going to move into our final market update, and then we'll get into the decision point report. So Tom, you can, and Greg, you can go take a nap until the end of the show. So let's look at our predefined alerts to start off our market update. And we can see that the Russell 2000, all of the green means, of course, that we're having a good day. As far as all of our indexes are concerned, it's clearly an up day going on. You can see right now that the industrial sector had a bullish crossover. We're looking at financial sector doing well this morning, and materials as well. But let's go ahead and look at our candle glance to see exactly in the very, very short term what's been happening with the market. And let's add the TSX in here so we can see what's going on. All right. So as you can see, I was gone yesterday, but I can see that we did have a pullback that continued, and now we're trying to make up for that. But you can see that we really, at least on the S&P and on the Dow, we really haven't challenged that previous top from yesterday. The NASDAQ actually did, but it has fallen back down. And we can see Russell 2000 also a little bit of a higher top than yesterday's intraday high. We also are seeing the TSX on a nice rise from this morning and continuing up, starting to flirt with intraday highs again as well. Treasury yields are up slightly. We can see UUP started to continue this nice rally that started about midday yesterday, but it is finally starting to pull back a little bit. We'll see where that support level will hold, but I'm looking at around this area right here where we had that gap. Commodities are higher. Notice USO is traveling mostly sideways. A lot of indecision, I think, going on in there. And I'll be looking at the USO chart shortly as part of the decision point report. Gold is mostly unchanged. The VIX is falling. We're starting to see a little bit more comfort as far as what's going on with the market among investors. And we can see that advances are leading at this point over declines. Take us back to the member homepage, look very quickly at the market summary, and then I'll get started on my DP report. I wanted to check first and let you know which of the sector spiders are doing well. I think we looked at some of this earlier. Financial, ETF, industrials, all leading over 1.25% up today. Energy and consumer staples are lagging somewhat. All the rest of the sectors are in the green. We can see paper, transports, airlines leading the way as far as U.S. industries, and three laggards: semis, REITs, and natural gas. The only three industry groups we're covering here that were in the negative. And that's going to complete our final market update. And with that, I'm going to go ahead and get us into the decision point report. So let's go ahead and get that going.
Yeah, I will just say, Erin, that I did do that XOM chart, and I have annotated it, so it'll be in the Market Watchers blog later.
There you go. Thank you so very much. All right, let's go take a look at, of course, it's going to refresh here. All right, so this is my Decision Point live chart list, meaning you can get to this if you go to the Decision Point blog under the blogs tab. You will get all of these charts live. So if you want to go back and look at some of them or check what's going on with our indicators, or you want to recreate some of these charts, that's the place to go. So I'm going to first take a quick peek at what's been going on in the market. I think it's encouraging to see that this declining trend that started last Friday has been broken through, but you can see it's at this point it feels more like a drift after getting that breakout. You're not seeing it?
Yeah, I'm not seeing your chart.
Thank you. Let's get that fixed. All right, now you should be able to see it.
Yep.
All right, here we go. So I think it's encouraging. We've seen that breakout from that declining trend channel, but honestly, it looks more like a drift rather than a nice strong breakout, especially since we've been consolidating sideways since that breakout. So I don't find it overly encouraging that we're seeing that. I wouldn't be looking for a great rally coming out. What I'm looking at when I see a lot of these charts right now are flag formations. And of course, those are bullish patterns. I'm not trusting them just yet. I am of the opinion that we still have another retest of either the 200-day EMA or at least over here where we had paused and had some pretty strong overhead resistance back in November. So I'm expecting to see that pullback. I'm not really looking at this as a pretty solid flagpole at this point, but we are seeing some great signs. We are seeing the PMO has turned up, which I like. And honestly, I was going through the charts and I apologize, but I missed, we had a new short-term trend model buy signal show up on Friday and I missed that and I apologize, but you can see the 5-day EMA is now crossed above the 20-day EMA on the NASDAQ 100. Not seeing that yet on the other 3 scoreboard indexes that I cover, but we've now seen that with the NASDAQ 100 and you can see we're getting a little bit of a breakout now above this area of a pause as I've been looking at these stair-step pauses and we're now at the next level to try and break above. This could be that spot where we're going to have some problems and maybe see the pullback. But when I look at these PMO readings and this nice strong move upward, it's hard to be overly bearish here, but I still think we need a pullback off of this rise. I'm not looking at this as a flag. All right, let's go to our indicators. So our ultra short-term indicators right now are reading neutral. I'm really not seeing much out of them. Looking at yesterday's readings that I missed. I'm seeing some elevated numbers here as far as breadth. But when you've got the VIX sitting right at the middle of it, right in the middle of the Bollinger Bands, I look at this as neutral. I'm not seeing overly climactic readings here in combination. If you want to go and say that these are, negative, sort of a climactic impulse going on here, you could look at this as a possible exhaustion of the buying, which is kind of what I would be looking at. We're getting this consolidation, but honestly, the consolidation has been a good jumping point as well. So what's really interesting right now are my short and intermediate term indicators. They are reading exactly opposite. So short-term indicators are looking bearish. We've hit very overbought territory and we are starting to head back down. And, I've been of the opinion that we sort of have to pay attention to bear market rules more than bull market rules after this big decline. So I think overbought territory is concerning as far as the short-term indicators. So to me, I think this bolsters the idea that we will get a bit of a pullback and possibly a test of this previous low. I don't know if we'll have to go that deep back down, but I'm going to be watching these indicators to see if we can get a really quick unwinding of them. And that would be a sign that we are ready for that short-term bounce after a possible retest of those lows. Now look at the intermediate term indicators, however. They're looking great. Let's see if I can make this a little bit better as far as seeing what's going on. I'm going to customize this. And this is how we get these charts to look nice for you guys to see everything. There we go. Much better. Much better. So what I'm seeing, I got positive crossovers on these intermediate term indicators. They're coming out of oversold territory rather than overbought territory. If you're following bear market rules, however, remember that oversold territory could be considered thin ice as far as your bear market rules go, because oversold conditions can persist in a bear market situation. I don't think we're quite there, but I would I'm going to be watching these indicators closely to see if we can keep up the rise. You can already see a little bit of deceleration starting on these indicators, but ultimately, when I look at the short-term indicators mixed with the intermediate-term indicators, I would have to say that short-term, I would expect either a bit more consolidation or a pullback. But these intermediate-term indicators looking so nice, I don't think that this is the beginning of a bear market, at least as far as my indicators are showing. I know we had a discussion about agree or disagree whether we were, and I went with the really the devil's advocate position that we were starting a new bear market, but I think you could make a case for that to some degree, which is what I did. But I'm looking for another move to pull back, test some lows, unwind those short-term indicators, and then let's get started again based on those intermediate-term indicators moving up. All right, so let's look at the big four: dollar, gold, oil, and bonds, and I'll give you my decision point perspective. So what I'm watching for right now on UUP is I see a double bottom that's possibly formed here after a pretty long decline, as we've been seeing. This would be your neckline. We'll have to see it break above that if this is truly a double bottom pattern. I think it's you can make a case either way, but what we want is a breakout above that neckline that would confirm the pattern, and then the expectation would be a move about the size of the pattern. And when I just did back of the napkin sort of idea, that was, I figured that was about a 50-cent rise. So we're looking at about 24.10. I would say right in here where we're looking at the previous neckline to this head and shoulders pattern we previously had. So I'd be looking for a test to at least get price up here in that 24.20 range. So I think we're looking pretty good for the dollar right now, and I am looking for it to rise. I mean, look at the PMO. We had a nice bull kiss on that PMO signal line, and now we're headed back up out of oversold territory. Looks like it could be time for the dollar to make its move, at least in the shorter term. So what does this mean for gold? And what am I seeing in gold? Because I know we all have our opinions. I've been bearish on gold, and I continue to be bearish on gold. I think this chart really proves the point. I did have, when I did my analysis of gold, I think I did it on last Wednesday. I can't remember exactly, but we had the PMO rising. We were starting to see this breakout from that declining tops trend line, but we hadn't quite gotten up here to test that previous high from last year. And so I was still feeling bearish about gold, and I still do. But I had a lot of signs kind of moving me away from that position, when I saw positive momentum and that breakout. But ultimately, I still have been very bearish on gold, and I remain that way. And now the PMO is pretty much proving my point. I would say, as far as my position, we got a bear kiss, a fake out, try and get some people in there. And then, of course, we can see yesterday that decline was pretty serious. If we go to, I'm going to go ahead and pull up GLD, though, just to look at that so we know what's going on today in gold a little bit more. And as you can see, no improvement really on the PMO. It's still heading down after not making it through the signal line. So I'm still, as far as gold is concerned, I'm still quite bearish. I'm still looking for a test at least at that 1300 level, but I think it could move even further, depending on whether we get that rally in the dollar and it can grab hold and really stick. But for now, I think short term, the dollar looks pretty good. So short term, I would be looking for gold to not be doing very good. I'm also a little concerned with this possible double top that could be forming right now. And that would leave us a neckline right around 1310. And a drop below that neckline could mean a drop of about 50 points here on gold. And that would, of course, put you all the way down here, pretty much exactly where I've written in a previous area of support. So pretty interesting, what I'm seeing anyway. So that's gold. And now let's see, we've got a little bit more time. I'll just do oil and bonds very quickly. USO, nice bounce. I've been pretty neutral on oil. I've been getting a lot of mixed signals. And I would say at this point, you know, I'm still feeling kind of neutral. You can see that the PMO is trying to make a turn up, and I think that is positive. But the 20-day EMA is posing a bit of a problem as far as overhead resistance. So we may need to just pull back here a little bit more, test that $12 level before we can make the move higher. But, you know, scooter ranking is still very strong. So USO is looking pretty good. And we got that bounce, you can see, for WTIC, actual oil prices, right at about that area of support, and we are starting to head back up. So right now it's that area of overhead resistance, I would say, at this previous low that could be a problem. So we'll have to watch that more closely. Finally, TLT. And here we go. We found some support. I've been looking for bonds to fall even further, and I don't think we're completely out of the woods yet. I think it's I think this might be a pause before it moves a bit lower. Because, I mean, look at the PMO. It really wanted to bottom and move higher, but it just can't. Even with this area of consolidation, I like to see that at least make a move up if we're going to consolidate a bit, and we're just not getting it. Scooter is still not looking so good. I like the OBV, which was giving me some hope here for TLT with those rising bottoms and tops. But looking at that PMO struggling, I'm still a little, I think this is a little suspect. The fulfilling of this double top pattern would have TLT going all the way down to that 114 level. So I'll be watching this support level closely. I'll be watching that PMO closely. At this point, I have to be more of a neutral to somewhat bearish on TLT. And that concludes the Decision Point report. And here are my concluding remarks. So they will be in the Market Watchers Live recap. But as you can see, that bearish bullish readings between short and intermediate term indicators, I think, is really interesting. And you can see my positions as far as the DP indicators go on the big four, as I call it. And with that, my goodness, there's what, 4 minutes left, Tom? Sorry, I kind of moved on in there and
that's fine.
Camped out for a little bit.
No, we wanted to get the update. And of course, you know, the S&P, as you mentioned, is just kind of flatlining at this point, which I'm not shocked, because I think that we do have a pretty big FOMC minutes report that's going to be released here in about a half hour, a little bit more than a half hour. And this is going to be interesting because the volatility index, I'm watching the volatility index, which has been dropping all day long. It's down into the 17s again. It's down 14% today right now, 17.72. And as I've pointed out on here multiple times, the last two bear markets, if you're looking at this huge drop that we had recently as the start of a bear market, the last two bear markets, we never saw the VIX go below 16. 16, 17 tends to be a really key area of support. And it makes common sense to me, because in a bear market, you have to have a certain level of fear throughout the entire period, you know, so that when a bad report comes out, everybody just jumps on it and sells. During a bull market, you see the opposite. You see a lot of complacency in that VIX reading, as we saw for so many weeks and months at 9 or 10, where the market doesn't care about any bad news. It just keeps chugging along. And as Arthur talked about yesterday, it's just very, very dull and boring action, which is exactly what I like to trade. This back and forth stuff is for the birds as far as I'm concerned. But anyway, volatility back into the 17s. We got a big report coming up in 30 minutes. And I do want to thank our great friend and special guest, Greg Schnell, for coming in here. Congratulations on the book, Greg. I think that's awesome. And if you haven't picked it up, go into the bookstore and make sure you get it ordered. They are flying out of the bookstore, no doubt about it. But again, thanks for your input today, Greg.
Thanks a lot, Tom.
Really appreciate having you. And Yeah, go ahead and give everybody the update.
Yeah, let's. So tomorrow we've got everything stock charts, and Tom, you've got a workshop on Friday. I think you're still taking a few requests for that.
Yeah.
So that is Friday, and with that, we're pretty much done. It's time to sign off.
Yeah, I do want to just kind of again let everybody know, using the survey at the bottom lower right hand part of your screen. There's a survey. How'd we do? You'll see that area. If you click on that link and let us know how the show went, what you think of Market Watchers Live, you also feel free to put in there a topic maybe for me to cover on Friday for the workshop that we do once a week. It's an educational workshop. So if there's something, candlestick related or whatever that you're interested in, send it along. Got a lot of responses yesterday. I did go through them, and I'll probably make a decision later today after we get some more responses today. But anyhow, that's coming up on Friday, and as Erin said, we've got everything stock charts tomorrow. So going to finish out the week in style, but definitely keep an eye on this FOMC minutes coming out here in about 30 minutes. I do want to thank everybody for stopping by and joining us today. Remember to complete that survey as you exit. We'd love to get your feedback and hear what you think of Market Watchers Live. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. We'll be back here on Thursday. Happy trading.